I hope you enjoy watching this video. This is the recorded lecture for Chapter 24 of Accounting 202, Capital Budgeting and Investment Analysis. And I will review the highlighted learning objectives. Capital budgeting is the process of analyzing long-term investments and deciding which assets to acquire or sell. Examples include buying a machine or a building or even an entire company. An objective is to earn a satisfactory return on investment. Capital budgeting decisions require careful analysis because they usually are the most difficult and risky decisions a manager can make. Capital budgeting decisions are risky because the outcome is uncertain, large amounts of money are involved, the investment involves a long-term commitment, and the decision can be difficult or impossible to reverse. We will look at the payback period. All investments are expected to produce net cash flows. Net cash flow is the cash inflows minus the cash outflows. The payback period is the expected amount of time that it takes a project to recover its initial investment. If the cash inflows of an investment are equal in each year, we can calculate the payback period by dividing the cost of the investment by the annual net cash inflows. Managers obviously prefer investing in assets with shorter payback periods. Here is an example of computing the payback period with even cash flows. You can see the details of buying a new machine here. We are going to use this formula. So the cost of the investment divided by the annual net cash flow. 16,000 cost divided by the net cash flow of 4,100 per year means that we will recover the cost in 3.9 years. If you have uneven cash flows, you have to do a separate type of calculation. So you can see that there are various net cash flows in the second column, and what you have to do is look at the cumulative net cash flows. So you begin with year 0 of the cost of the investment. And then each year after that, we start to come out of this negative amount. So you can see after year 1, we take negative 16,000 and subtract the positive 3,000 to get negative 13,000. And you keep doing this until you find out where you come out to basically 0. You can see that it's sometime between years 4 and 5 because we're negative 1,000 at the end of year 4 and a positive 4,000 at the end of year 5. So we are going to take the 1,000 that we need to recoup and divide it by the 5,000 in year 5 to get 0.2. So then we know the answer is 4 years and 2/10 of a year, so 4.2. We'll look at another method called the accounting rate of return. The accounting rate of return is the percentage accounting return on annual average investment. It's based on net income as opposed to cash flows. It's computed by dividing the project's after-tax net income by the annual average amount invested. The annual average amount invested is the average book value. And we're going to just assume for simplicity that the company is using straight line depreciation. When using the accounting rate of return, we can choose among capital investments with similar lives and risk, and a company will prefer the investment with the higher accounting rate of return. Here are the example calculations. Fast Track is considering purchasing a new machine that costs $16,000 with annual after-tax net income of $2,100. To compute the annual average investment, we take the beginning book value, which is $16,000, add the ending book value, which is the salvage value, and in this case it's 0. So we take those two numbers, add them together, and divide by 2. So we're looking at an $8,000 annual average investment. Next, we will divide the annual after-tax net income of $2,100 by that average investment of $8,000. So we get an accounting rate of return of 26.25. And so then management would have to decide whether 26.25% is satisfactory. We will look at another method called net present value. Net present value applies the time value of money to future cash inflows and outflows. So net present value is computed by what's called discounting the future net cash flows from the investment at the project's required rate of return, and then we subtract the initial amount invested. The company's required return is also called the hurdle rate or the cost of capital, which is the rate the company must pay to its long-term creditors. Here's an example with equal cash flows. Again, they're looking at purchasing a machine that costs $16,000 with an 8-year useful life, 0 salvage value, and annual net cash inflows of $4,100. They require a 12% annual return. So we need to find the present value of the future cash flows and then multiply that by the net cash flow. And we are going to look at the table B1 of Appendix B, and we have 8 periods that we're looking at under the 12% column, and that's where the present value factors come from. So we will multiply 4,100 times each of the individual present value factors to get the present value net cash flow for each year. Add those together, subtract the initial investment of $16,000, and then we look to see if we have a positive number in the net present value. So basically, as long as the net present value is a positive number, then they should invest. This summarizes the decision rule. So as I mentioned, if the net present value is greater than 0, they should invest. If the net present value is less than 0, then they should not invest. Now we will look at a method called the internal rate of return. So another way is to use the IRR, or internal rate of return, which equals the discount rate that will yield a net present value of 0. So stated another way, if we compute the total present value of the project's net cash flows using the internal rate of return as the discount rate, and then subtract the initial investment, we get a 0 net present value. Here's an example where the project being considered has a cost of $12,000 and has returns of net cash flows of $5,000 and a useful life of 3 years. So we're looking at 3 years, $12,000 investment, and annual net cash flows of $5,000. So we have a 2-step process. And this is when the cash flows are equal. So the first step is we're going to take the cost of the investment and divide by 5,000, which is the net cash inflows. That will give us a present value factor. So in the next step, we need to look at table B3 in your appendix and find the number that's closest to 2.4 in the 3-row column. So we're looking for 3 periods, and then we're just going to go across in the table and look for the interest rate that is closest to 2.4. So here we can see that 2.4018 is the closest number to 2.4. And this means that the internal rate of return is approximately 12%. With uneven cash flows, it's a more difficult computation, so you have to use a calculator or spreadsheet software, but we are only going to be looking at even cash flow calculations. And the bottom part shows the decision rule for the internal rate of return. If the internal rate of return minus the hurdle rate is greater than 0, we will invest. And if it's less than 0, then they should not invest. This concludes the video lecture for Chapter 24.